Interest rates, the 10-year yield at 171. They've been up lately, wondering where all of this, Jim, now leaves us as we're about to head into a new quarter.
Well, this is an extraordinary day because it's the exact opposite of everything else that's happened this quarter. I know one of Stephanie's favorites is Cisco. We talk about IBM. This is a day where people want to throw those away. I'm wondering, and I'm going to put it right, if you don't mind, Judge, put it right to Steph, because she's in this world. Steph, how much of this is fund managers who don't really have to show that they're buying these ones that they regard as losers, and so they're just saying, you know what, I can get a fresh start? And how much of it is just some sort of like, you know what, these are so beaten down, we got to buy them?
I think they're so beaten down that you want to buy some of them, not all of them. But I don't think the narrative changes just because you flip into a new quarter. The stimulus is still in the system. We're going to get another $2.2 trillion in infrastructure spend. Growth is going to be better. Last night we got better China PMIs. Today, Chicago PMIs, best since 2008. Consumer is doing just fine. I am watching housing. Housing is where the narrative is starting to change, I think, on the margin, because they have very difficult comparisons. But I think that's a function of supply, not demand. But the point of it is better growth leads to better rates. And then what you want to do is have some of the companies and have exposure to some of the companies that are going to benefit from that better growth. That said, technology can certainly be included in that. And as to your point, they're beaten down. So you want to pick and choose where you want to go. Look at the end markets of where you want to be. 5G, cloud, AI, data center, all that stuff still sticks. And you can pick a lot of different names here.
Jim, it's funny that you went right to Steph and you brought up the Ciscos of the world. You know, people are focused on IBM and they're talking a lot about Intel and maybe not so much the FANGs of late. And, you know, we did that CNBC quarterly survey, and the exclusive question for us is which tech stock will have the best total return this year. 49% say Intel, 30% say Cisco, and now they're relative to some of the, the Cathie Wood stocks, if you will, the Teladocs or Zoom. They think it's the old value tech is going to outperform the growth tech in this quarter ahead, Jim.
Well, I struggle with that because these have already just completely, the ones that are up 49%. I mean, Intel, that is just a charm offensive. That's Gelsinger charm offensive. Cisco, the numbers are probably too low, although I didn't like yesterday Chuck Robbins on Yahoo Finance is talking about the possibility of DRAM problems or semi problems. Teladoc is problematic. Why? Because there are other companies that have come in that have challenged them. So that leaves me with Zoom. And Zoom is a Cathie Wood name, and I'm so glad you went to them because I think, Judge, I would love to hear from everyone on the panel whether this last fund, this fund that is about space exploration, is finally a fund too far. Judge, is it time to own JD.com, Alibaba, Tencent, Google, Netflix, Amazon, and Alphabet as a space fund? Or is that the show that when I was growing up called Lost in Space?
You know, look. Here is where I think the environment is right now, Jim, and this is no BS, okay? I had somebody who's on an NFL coaching staff yesterday who's on his way down to one of the pro days ask me via text where I think the NASDAQ is going and those Cathie Wood type stocks because they're invested in those names. I mean, I think the broader environment, I use that example to say that
was it a jet?
There was not. There were a lot of people who invested in those names. Okay?
Yes.
They've been the glamour names, the popular names, the retail names. They've all had huge pullbacks, okay? Month to date, the Teladocs of the world are down 18%, Roku's 18, Zoom's 14, Spotify 12, Shopify 13, Zscaler 16, DocuSign 10, CrowdStrike 15. I bring that up, Doc, to, what do you tell that person who is speaking for a larger cohort, right? I mean, it's a voice of a larger group of people who want to know where are those stocks going to go in the next quarter? Are they dead? Do I need to rotate and put my money elsewhere?
I don't think they're dead. I would be a buyer of most of those names, and I won't reiterate them, but I would be a buyer of most of those names here, Scott. But after they saw those big pops in, obviously 2020, but then in parts of 2021 as well, we've seen many of those catch fire again, only to flame out. I think at the end of the quarter, this is a logical time to pick up some of those beaten names because people don't want them on their sheets, just like Jim and Steph have just discussed. They can stealthily get back into some of those names. So for that coach who's traveling down to those pro days and so forth, I'd say, yeah, now would be the time. If they're already in them, I would say hold them. So in other words, that's the question of hold or buy. I would buy them if they're not in them. I would hold them if they're still in them.